Okay, welcome. Welcome, everyone. We will wait some minutes until everybody joins. Okay. Okay, Camille, you let me know. Okay, there are still some people joining. So in 1 minute, we will start. Okay, good. So welcome everyone to our Green, Inclusive and Climate Smart Finance Action Group webinar, part of our webinar series. And today we're very pleased to have Agustin Vitorica, co-CEO from Gaa Capital. And with the title of this webinar, Transforming Microfinance Institutions for a Greener and More Inclusive Finance, which is exactly what we want in our sector, and we're very pleased to have a fund here sharing with us how its efforts are bringing microfinance institutions for a more greener and more inclusive finance. So as usual, we will have first an introduction of the action group activities, and then we will have the presentation from Mr. Vitorica for 20 minutes. And at 4:30, we will continue with 30 minutes of discussion, and we look forward to your questions and comments. During the presentation, you can write your questions in the chat or in the Q&A, and we will read them then afterwards when Agustin is done with his presentation. So with this, let us start. So the Green, Inclusive and Climate Smart Finance Action Group is a unique multi-stakeholder think tank where we discuss environmentally responsible inclusive finance. We pursue different objectives, which is to discuss current challenges and strategies, as we're going to do today, improve the knowledge and action of inclusive finance actors in environmental issues, enhance the cooperation among stakeholders, increase international attention, develop dedicated tools that are recognized as standards, publish and disseminate our findings, and enhance the interest and concrete commitment. So usually we are having this type of webinars, also creating materials and content, and already publishing tools for the sector. We have been established and it was conceived, this group, in 2013 with a very long-term commitment. And we are hosted by the European Microfinance Platform. It has over 130 members with different levels of engagement, affiliated more than 70 institutions, and are organized also into subgroups, among which you can see here the list of organizations. Davide Forcella, co-founder from Yapo Solutions and researcher at CERMI, is co-head of the action group together with me Natalia Real Pecarrillo, CEO from Edera Sustainable Solutions, and Klaus Topfer, Sustainability Fellow at the Institute for Advanced Sustainability Studies in Potsdam. Our impact and traction since in this year can be seen here with this matrix with the increased number of action group members, the newsletters that we have published, and the subscribers, the webinars and presentations that we have conducted over the year with public events, and more than 150 participants per month. We have launched the Green Index 3.0 and developed together with SPTF and Thesis the Dimension 7 of the Universal Standards for Social Performance and Environment, Social and Environment Performance Management, and have also strategic collaborations, invitation to external events, and engaging also as well green heroes, financial service providers, and analyzing more than 1,000 environmental assessments of microfinance institutions. This year, we have finalized the Green Index 3.0, finalized the tool, as I said, the Dimension 7, as a joint work from SPTF and Thesis. We have been preparing a training series on the tool this week, taking place in the version already in English was on Monday, yesterday in Spanish, and on Friday in French. We are preparing now the state of the art of green inclusive finance that will be ready by the end of the year. We've been working on regulation and green inclusive finance, digital and green inclusive finance, and green finance in Europe in collaboration with the European Microfinance Network. We've developed guidelines for green products development and disbursement, working with the green heroes and microfinance institutions, and develop webinars, newsletters, preparation of 2-pagers and discussion papers, and transform the Green Index also into a digital tool. We are working to increase the sector understanding and action in green inclusive finance. This entails also the online library that we have launched and we have ready, and it's already in the website from the action group, where you can find more than 500 documents all dedicated to green inclusive finance. And as you have seen, we have also a new website that you can find at the European Microfinance Platform website. And it has you can have access to all the different activities that we are currently conducting. On the Green Index 3.0, we want to show the extensive experience that it has. It's an evolution from the Green Index that was launched in 2014, and which has already been applied in different projects and also by different stakeholders. And this year we have mapped and aligned international initiatives, conducted in-depth interviews with microfinance stakeholders, also collected feedback with more than 200 stakeholders, and have different rounds also of reviews and development of all the indicators and essential practices of the standards. Here a brief overview of the evolution of the Green Index, launched in 2014. Then in 2016, already incorporating lessons learned from microfinance institutions, including quantitative components, and integrated into the SPI4, only the qualitative indicators. And now in 2021, we have finalized the tool, including, or the main innovation is the inclusion of the concept vulnerability. The work that we have done together with SPTF and Thesis, developing the Dimension 7, we have also aimed or strived to have these tools where the Green Index provides a very detailed overview, while the Dimension 7 is more a global view of the environmental performance of microfinance institutions. However, both tools serve in order to help institutions to align and prioritize their actions, see the multiple options that they have in order to commit to environment protection. As you know, this is a webinar series where we are dedicating spaces for green inclusive finance, brief presentations by practitioners and academics. It's an opportunity for discussion and also for networking for you. And materials and video will be available online. The sessions are are all recorded and will be available also in YouTube. So everyone is invited here to speak, and if you would like to participate for next year, you can feel free to contact us. And with this, I welcome Agustin Vitorica to initiate your talk, Transforming Microfinance Institutions for a Greener and More Inclusive Finance.
Okay, no, thanks very much, Natalia. Thanks very much to all the action group for giving me the opportunity to explain what we do at Gaa Capital to transform our investees, MFIs, to become more inclusive and greener as well. So, and first, in the next slide, I'm going to talk a little bit about Gaa Capital for those of you who don't know us. So in the next slide, we can see Gaa Capital is the largest impact investing firm in Spain, with assets under management exceeding 200 million euros. We launched 4 different funds, where we did over 43 investments in more than 15 countries. And our first 2 funds have already delivered good financial returns in excess of what we were expecting. We invest in a mix of debt and equity investment to provide returns between 6 and 7% per annum in euros to our investors. And our philosophy was bringing the best practices in private equity to this field. I mean, many of us in the investment committee come from previous private equity background, but our idea was really to invest in MFIs that were not tier 1. I mean, really focusing on more tier 2, smaller MFIs in growth process, where we can really add value. You know, additionality is a very important word for us. So more than 2/3 of the investments we've done in MFIs are investments, you know, targeting rural population. So that has been very important for us from the beginning. So maybe on the next slide. Yeah, so these are the funds we've launched. As you can see in the center, our first fund, Gaa Microfinance Fund, the second Global Financial Inclusion Fund, and the third one, Magallanes Impacto, which was a result of a partnership with a very large value investing asset management firm based in Spain with over 1.7 billion euros in assets under management. All these were focusing on financial inclusion. Financial inclusion, as I said, especially in rural areas, and always with a transformative, I would say, mission, you know, where we can help based on our experiences and in the experiences we gain in different regions. We could really help these institutions to grow and to adapt their products and services to the most excluded population. But then we launched in 2019 a new fund called Uruma Fund, which is a partnership of Gaa Capital in collaboration with Cofides, which is also a member of the Action Group, which is the Spanish DFI, and in collaboration with the Spanish Development Agency and the European Union, which is a fund that wants to tackle a specific challenge. In this case, was basically providing access to finance to smallholder farmers, so that smallholder farmers can really get finance from MFIs and increase, I mean, and get better inputs and increase their productivity and the quality of living of their households. So in order to achieve this, we needed technical assistance so that we could implement solutions that really transform the business models of our investees to be able really to properly serve smallholder farmers. So this fund is already invested over half of it, and we found a lot of demand from a lot of MFIs in all regions that really are present in rural areas but didn't really know how to tackle the smallholder farmer segment. And then we're currently, it's work in progress, but we're currently working also with Cofides as well in a future fund that we call a Quali Fund, which will continue what is being done with smallholders from Uruma, but will also include SMEs, which is another segment of the market that really a lot of MFIs don't really know how to serve. And it will very much focus on green lending, on how well are the MFIs adapted in terms of environmental risks, and how do they implement an environmental strategy, from internal risk to external risk to really fostering green products, So that's the idea of our future fund, very much focused on climate change. So next slide. So what really set up apart, GAWA from other impact investing firms is what we call the impact management system. So the way we work is we usually identify a major social problem which can be addressed by the private sector in a sustainable way. And we very much base our interventions on scientific evidence. So we need to see scientific evidence of why, if we do this investment in this specific MFI and we transform this MFI to offer, good products or services to specific clients, that there has been scientific evidence that demonstrate that an impact in the livelihoods of these clients is really produced. Then what we do is actively managing the impact. It's not, for us, it's not about measuring impact, because as well as in the financial side, you don't only want to measure, you want to increase the return during the life of the investment. We do exactly the same on the impact side. So what we do is we work with our investees and make an action plan for increasing impact during the life of the investment, and we finance this plan with technical assistance resources that we have from the European Union. And then once we do this, we align our economic incentives with the impact produced, and this is very important. Our carry interest is tied to what we call the social impact score. That is audited by a independent third party that is chosen by the investor. So every time we exit an investment, the investors send a social auditor on the field that really comes back with this social score, audited social score, and depending on how large is the social score or low, we have a higher or lower carried interest. So this way, we are aligned with all investors, and all of them know that it is in our best interest not only to choose good institutions from the social side, but also to increase the impact of this institution during the life of the investments. So that's also related to the last point, independent verification of impact, and this is what I just explained. So in the next slide, and I'm going to talk more specific about our impact thesis and how do we see it from a green lending perspective. As you know, there are two segments that are very important for climate change. One of them is SMEs. SMEs in the world represent approximately 65% of total industrial pollution. So it's an important actor in terms of emissions. On the right hand, you have smallholder farmers, and smallholder farmers really represent 70% of the world poor and 80% of the malnutrition. And these smallholders really, they contribute the least to the climate change, but they are the ones that are really suffering the most the effects of climate change. So for us, fighting against poverty is basically impossible if we don't help these smallholders adapting to climate change. There you see some figures. 95% of smallholders in Latin America are already experiencing the effects of climate change. You see there the lower productivity of corn producers and coffee producers, And you see that 32% of these smallholders are already suffering from food insecurity derived from extreme weather events. So this is why we're starting Uruma and why we're starting Kuali later. But on the other hand, there is a big opportunity for investors to really invest in green lending. Green lending is expected to double its size. From 2016 to 2030, will reach $44.5 billion, becoming 30%, almost 1/3 of total lending from financial institutions. So really, it's a very, very attractive sector to be in. But to really serve SMEs and smallholders, the institution needs to adapt themselves. What we call, adapting their products. I mean, you need to offer products that make sense. I don't know, in the case of SMEs, you need not only secure lending, also unsecured lending. You need short-term lending, long-term lending. You need all kinds of solutions. And in the case of a smallholder, even worse, you really need products, credit that really adapt to the cash flow cycles that smallholders have in their activities. So the institutions need to adapt these products. They need to train the employees. The employees, in order to properly serve smallholders, they need to understand agriculture. They need to have previous background or training in agriculture to able to evaluate the risk of the smallholder production that is doing. And additionally, these institutions also need risk management systems so that they can properly manage agriculture risk, diversified geographically, diversified by products in each geography, also including climate data, so that they can forecast what's going to be the behavior of their climate, of the climate in the country, and what is the expected outcome for the smallholder farmers that they are financing. And also in terms of technology, digital financial services is very important. And a lot of institutions really need to do it in order to speed up the process of turnaround time to get the credit to the smallholder as quick as possible, and also to allow smallholders really to pay in a point which is not at too much distance from the place where it's doing its activities. So in next slide, this is our theory of change very quickly. So basically, we put some inputs, which is financing and technical assistance. With finance, we expand the outreach of the MFIs to this specific segment, to smallholders or to SMEs, and we transform them, the processes, the products, the people, and the technology, as I just mentioned, so that they can offer tailor-made solutions for these specific segments of the population. With this, we get some outputs. So MSMEs and smallholders, they receive lending, and ideally, with the TA, we will foster green lending. So, so in this way, they will become more resilient to climate change, and they will get loans that allow them to both adapt and mitigate climate change. And with this, we create impact, for MSMEs in terms of growth for the country, for the rural communities, and for the planet overall, where climate change will be reduced through these actions. So this is very well explained through an example. So next slide, next 3 slides, I have a specific example for an investment from Uruma. Next slide is an MFI called Crezcamos. And Crezcamos is an MFI in Colombia that, when we do our first audit in our social due diligence, we first evaluate how is the institution adapted to serve smallholder farmers. And there you have the scores, the scores, the institution, is very well adapted in this case. So the institution has already products specifically adapted for smallholder farmers. They also have parametric insurance related to agriculture, so it has a very good product for smallholder farmers. It also has adapted its process, and it has an agricultural risk system, which allows them to really mitigate the risk. And this system, sets specific limits per product, per geography, produce a specific report for the board of directors. And then also they have a certain number of people, 27% of the employees have received agriculture training in order to understand the risk that they are, that they are approving at the end of the day. So very well adapted to serve as smallholders. But then after this evaluation, then we do a second evaluation, which is what we call the green adaptation in the next slide. So in the green adaptation, we use Green Index 2.0. We will love to use Green Index 3.0, which is when it is finally launched. So here, we have different scores. What we see is that the institution is managing well its internal environmental footprint. It's low consumption of energy, water, paper, buying energy efficient equipment, etc. So in that sense, they have a full score. But then, they even though they have a committee in the board dedicated specifically to environmental activities, they still haven't really approved a formalized environmental strategy. That's why in the environmental strategy, the score is quite low. It's only 25% over 100. In terms of external environmental risk, they have already started to integrate environmental risk, in training to smallholders, but they haven't really integrated it in the loan approval process. So still loans, even if they provide training to smallholders, loans are given without having, having taken into account the environmental risks, of this specific client. And then in terms of green opportunities, they still haven't launched a specific green products for SMEs or smallholders. So that's why they score 50%. They have the parametric insurance, which is very good. So that's a product. That's why the score is not 0. But still, there is a long way to go in terms of green products for their clients. So in the next slide, we will see that this could be solved with our technical assistance. So in our technical assistance, we are thinking of several projects with them. One of them will be, launching broader insurance products related to environmental risk, so that we can, continue protecting their clients from the environmental impacts. Or another is, financing them and helping expanding into environmental adaptation systems, ecosystems-based adaptation, more specifically, Like, for instance, first integrating climate risk evaluation in their approval process, or maybe even launching new products for adaptation, including revenue diversification products, sustainable agriculture practices with good use of resources, water, more resilient inputs, etc. So all of that, which is in the right hand of the slide, we can do it with our technical assistance, so that when we will come out of the investment from Uruma 6 years later, Crezcamos will be left, with more green products and better impact in the lives of smallholders and on SMEs as well. So this is basically an example of a transaction we've done already this year, 11 transactions of this kind, and this is the way we work. To finish, I wanted to stress that in this fund, Uruma, and as will be the case in Kuali, the financing structure of the fund is particularly good to attract really private investors to this segment, to this segment of impact investing, which is usually perceived as more risky because you are dealing with smallholder farmers. So the perceived risk of agriculture is very high. You are dealing with SMEs, which really lie in the middle between microfinance and traditional banking. So it's also very risky. So in order to do that, we use what is called blended finance. So maybe in the final slide, I can give an quick overview of what is our blended finance of the Uruma fund. So on the left-hand side, you have the fund assets. How are we going to invest it? So Uruma has been invested 70% in rural focus MFI that want to expand their action into smallholders. And also we invest in some specific rural SMEs, that maybe source their products from smallholders, put them in touch with markets, and so we can do up to 30% of investments also directly in these rural SMEs. Most of our investments are debt, specifically senior debt, but we also invest 30% of the fund. This is a 120 million fund, in equity or in mezzanine transactions. So we buy common shares of microfinance institutions, which we later sell to other investors, all in the public market. And in terms of geography, we're very much focused in Latin America and Sub-Saharan Africa, because that's very much related to the priority sectors of the European Union geographies and the Spanish Development Agency priority countries. But we also invest 30% of our investments in Asia, specifically in India. We've been very active with private equity investments. So on the right-hand side is the most interesting side, because we have there all the different tranches, of catalytic capital and private investors. So what we have at the bottom is a 10 million first loss tranche that has been provided by COFIDES, the Spanish DFI, with resources from the blended finance facilities of the European Union. In this case, it was provided by AgriFi, the blended finance facility focusing on agriculture. So these 10 million are invested with the rest of the money, but all the return goes to the private investor until the private investors have a 4% IRR per annum in their pockets. So it's not only a first loss, it's not only a tranche that protects against first losses, it's a tranche that is protecting the private investor return up to a certain level. So that's a strong catalytic capital, but in addition to that, we have 20 million from the Spanish Development Agency. So in this case, the Spanish Development Agency didn't want to delay its recoupment of capital till private investors have a return. In this case, the Spanish Development Agency says, look, I'm going to get the money pari passu with private investors. But given that I am a public investor, more focused on impact than in anything else, I can cap my return at 2.75%. And any excess return from 2.75% per annum, I'm going to give it to the private investors. So this way, private investors have a de-risking tranche and have a return enhancement tranche, that takes them, really moves them to the efficient frontier of risk return, which is very much in line, with the fiduciary duties of institutional investors specifically. Institutional investors, it's very hard that they invest in high impact funds like this if they don't have this blended finance structure that really takes care of the fiduciary duties, So with this money, we managed to, just in 9 months during 2020, and many of the months during the pandemic, we managed to mobilize 90 million from private investors in just 9 months, where over 70% of this money came from institutional investors. We have large pension funds, large banks, large insurance companies. So it's been really successful in terms of mobilizing private investments towards this sector, which is clearly perceived as high risk. And also, at the bottom, you have, which is of most importance, the 8.5 million of technical assistance facility from the European Commission as well, that we are going to use to transform these investees to really become more inclusive, serving smallholders and serving MSMEs, and greener through the adaptation that I just commented a few slides back. So that's basically my presentation. Thanks very much for your attention, and I'm here to answer any questions you may have.
Thank you very much. Thank you very much, Agustin. I see that your presentation has raised a lot of interest because while you were talking, many questions have arrived. So I want to leave this slide because I guess like most of the questions are targeting this type of, about the fund that you have. So let me start with the questions for those that are connected.
Some of them you already responded, like on the geographical focus, for instance. No?
Yeah. So let me read the questions so that afterwards in the recording, people can know what are you replying, as they will not see the chat. So we have here the first one. Does GABA focus only on Latin America or also Africa and Asia?
As I said, 70% must be in either Latin America or Africa. I will say that most of that 70% will be in Latin America. I will say about 15% will probably be invested in Africa, and the rest will be invested in Latin America. And we also invest in Asia, but with a maximum of 30%.
Okay, maybe before we continue, if you can tell a bit about the process. How can institutions approach you? How long does the whole due diligence process take?
Yes.
What are the timelines?
Exactly. That's a very good question. So, well, any interested potential investee can go to our website, send us an email, and we will make contact with them. And usually our process has two phases. One is the preliminary due diligence, where we collect information from the institution and prepare a document for approval of our investment committee to go to do on-site due diligence. And then we go there and we stay there, I don't know, for a week, 10 days or so, where we go very deep, with all the management. We do a lot of field visits. We do all this social due diligence, and usually after that we prepare our investment committee memorandum for approval of the transaction. Then it goes into long-form documentation and we disburse. I mean, the ideal is that all this happens in a maximum of 3 months. That's what we're targeting. So we're kind of agile. I mean, we can really move quickly. We are 10 people in the team, so we have dedicated people that will go to a specific geography and move very quickly. So anyone interested in receiving financing, please contact us, and we will continue the conversations with you very happily.
Good. So you mean 4 months, but doesn't matter which point of the year they apply, and the mobilization is always from Spain. Like you don't have offices.
We don't have local offices. Basically what we do in our lives is at least 6 months per year we're traveling.
Okay.
So we are traveling to every single country, and that's what we do. And that's what the team likes to do as well. At some point, maybe, I don't know, at some point we will probably open local offices in some geographies, but so far what we're doing is sacrificing 50% of our time to trips, to due diligence trips.
Well, yeah, sacrificing, but also investing in the relationship with your investees. Yes, very good. Thanks for sharing about the processes. I think this will solve also many questions. So the second from Arpita Palagrawal, thank you for participating. What specific green metrics do you track and review during the pre-investment due diligence and post-investment to evaluate the impact of green lending?
Yes, so the very interesting question. So we're very much focused on these transformative metrics. So if you took, the dimensions of the green index, the strategy, the internal risk, the external risk, and the green products, we track that through the life of the investments. And if with technical assistance, this score are incremented, are increased during the life of the investment, that's what we do. And that becomes a quite, I would say, important part of the social impact score that determines our carry interest. Because for us, all of this is about transforming local infrastructure. What we want as impact investors is to leave microfinance institutions locally that can continue this flow of money to these segments even once we have exited the investments. So these metrics that I saw for Préstamos, that's part of the due diligence, we will continue to monitor them, and they will be audited at the end of the investment to see whether the technical assistance is really doing the transformation we intend. But also, of course, for those institutions that are already offering green lending, what we do specifically, is interviews with smallholder farmers to really, see how the productivity has increased, how really they've been protected against climate events, and also for the SMEs, the amounts of carbon, tons of carbon dioxide that have been avoided, as well. So this is basically what we measure.
Okay, it's very good to know that you are using the Green Index 2.0. So you will be also very keen to know the evolution to the 3.0 and also in its digital format so that you can keep track of all the indicators.
It's true.
And
something I forgot to mention is we are both my partner Luca and myself, we are Thesis SPI4 auditors. So we do the SPI4, and as part of the SPI4 now is the Green Index, and Green Index 3.0 will also be part of the SPI4, if I'm not mistaken.
Yes. Very good. Also, I think we will share with you, Arpita, access to the tool so that you can see it in more detail.
Sure.
The next question comes from Nepal, Vijay Kumar Gurung from Muktinath Vikas Bank. And I will join this question also from Govinda Raut, who posed just the question. So I think the answer was already given if the debt is available for Nepalese institutions.
Yes.
And
yes.
Govinda was asking if what is the minimum and maximum term of the debt. So you can provide more information about that.
Right. So yes, we are open to to these geographies as well. I mean, it's when we say Asia, it doesn't necessarily mean India. We invested in many Asian countries, and I mean, we're very much open to see any potential opportunity there. In terms of the duration of the loans, we provide loans for 2 or 3 years, which are renewed for another 2 or 3 years, depending on specific social metrics. It's depending, like for instance, the number of smallholders you are reaching, where you met these targets, or whether the transformational targets have really been met. So we can go up to 6 years, including this renewal of the loan for an investing institution.
Good. Thanks, Agustin. Thank you also, Govinda and Vijay, for participating, and welcome to be here. Another question from Rian is investments into agroforestry and machinery often require larger amounts on longer duration. Are microfinance institutions ready for that? And how does Gaa Capital fix the maturity gap with its funding?
That's a very, very, very pertinent question. It's true that agroforestry and machinery and other ecosystem-based adaptation loans have a higher maturity, you know. Well, for us, I mean, first what we do is we provide with large tickets. You know, our ticket size for the MFI, you know, ranges from minimum 3-4 million to a maximum of 10 million. And then, you know, what we do is we use patient capital, you know, so in this case, in order for the MFI to use this funding for this kind of longer term and larger ticket financing, you know, what we will do is maybe give longer periods of maturity for the debt, you know, going maybe from 4-5 years or more, you know. So in that sense, we're quite flexible. We can really move in the whole liability side of the MFI, and even including subordinated debt, you know, which is more patient than senior debt, you know. So so that's what we do to facilitate, you know. It's true that at the end of the day, in any case, the MFI has to monitor the liquidity, and this has been essential, especially during the pandemic. So some MFIs may not be ready to really, you know, engage in this kind of financing for their clients, you know. But I mean, we've seen different cases, you know. I mean, for us, what is important is that the MFI makes it transition to a green institution, and ideally ends up starting with some green products, even they are not specifically long-term products, you know. And farther down the road, maybe in our next fund, you know, then maybe we can push them more to get into, you know, offering these loans for agroforestry or other longer terms, you know.
Okay, so does it mean, or would you say that, also considering the title of the presentation, that even if an institution doesn't really have like already the very established green strategy, through the technical assistance and through your support, they can evolve their strategy into actions that will be measured and tracked, so that through all their access they can improve their environmental performance management.
Exactly. That refers to the title of the presentation. You know, I mean, this is a journey where we want to help, we want to support MFIs that are willing to, you know, first serve segments that are underserved by MFIs, like smallholder farmers and by MSMEs, and then, you know, support them in this process. You know, I mean, this is not made only for MFIs like Crezcamos, which has already been adapted to smallholder farmers, and they already have some green products and they want to expand. This is also good for MFIs that still haven't got really into the environmental strategy at all, you know, and want to start this journey with us. And that's where the technical assistance comes into play. You know, we help them through this journey so that when we leave, they are really greener institutions, you know, starting to provide green products, you know.
That sounds very good, and also yeah, very rewarding that there are so this type of funds are committed to environment protection. The next questions from Stefania Sanchez. Yes, as we will be sharing slides and materials and recordings. Olusola Olaniyi, welcome to the presentation, to this webinar, and he thanks for the practical presentation. Charlotte Rasaka Haribelo from Madagascar. Welcome, Charlotte. He asks, why don't you subsidize microfinance institutions? Because they have to innovate in the processes, which increases their costs. So what is your position about subsidies?
That's true. I mean, well, number one, technical assistance money is a subsidy, it's a grant, you know. Technical assistance money is precisely covering this cost of doing a more inclusive and greener adaptation. So that's number one. Number two that we are considering for our next fund is maybe increasing the return enhancement tranche. You know, if we increase the return enhancement tranche and the private investors get enough return, maybe the fund can offer lower interest rates, you know, to the MFIs, and the private investors will still get an attractive return because of this return enhancement tranche, you know. So that's an idea that we're thinking, you know, if we're modeling it right now, you know, to see whether it makes sense really to you know, to have a larger tranche from the Spanish Development Agency, so that this return enhancement puts really the return at the appropriate level for the institutional investor and allows the fund to maybe go a little bit lower in interest rates, specifically for the green strategy.
Okay. Thank you, Agustin. I think it's so. Charlotte, if you have more questions about it, you can post them. Ali Mohammed, Ali, thanks for the presentation. Rian, also, again, another question from Rian Haselega. He asked if you finance in local currency.
Sure, we do. I mean, every single investment we do is in local currency. So our strategy for our investors is all these local currency loans that we provide to the MFIs, we hedge them perfectly against the euro through cross-currency swaps or through forwards, you know, so that, you know, we disburse in Crezcamos, for instance, we disburse Colombian pesos, and we hedge all the cash flows in Colombian pesos against the euro, so that we can tell our investors, look, we are going to get these collections in euros. In equity, we don't hedge. What we do in equity investments, I mean, hedging is very hard because you don't really know the value of the underlying asset that you want to hedge, and the time horizon of you know, the investment. But what we do there is we analyze the evolution of the currency for the last 3 to 5 years, and we input the maximum depreciation of the currency during those years. And when we do our return model, the returns have to make sense after the depreciation. So we approve investments where the return makes sense, even if we get the larger depreciation historically. Basically, that's the way we do it. But for the MFIs, every single thing is done in local currency.
Okay. So before we go into the question about green finance, there was one question about your position towards loans, giving loans in Tanzania, if an NGO can qualify. I think if you can give more information about the requirements and size of the institution that you usually invest in, would be good.
Right. So yes, I mean, any legal entity can qualify. I mean, we have already invested, you know, in NGOs, asociaciones in Latin America, non-bank financial companies. That's our sweet spot. I mean, banks, you know, institutions which have a banking license are usually the largest ones, and as I said, that's not really our sweet spot. We also have lended to cooperatives as well, credit cooperatives in Latin America as well, and lending to non-bank financial institutions in Africa, for instance, we started as well. So in terms of size, I mean, we don't like to be, you know, more than 10% of the assets or liabilities of the institution, you know. So if our minimum desired ticket is 3 million, I mean, the institution must have a size of 30 million, you know, in assets. Total assets. I'm not talking about a credit portfolio. I'm thinking about total assets. So that's more or less, I mean, that's our sweet spot. You know, we finance institutions ranging from 30 million up to, I don't know, 80, 90 million. That's usually what we do.
Okay. Very good. So we can go to the last question, or if there are more questions, just post them in the Q&A. I think it's a very punctual webinar. Is from Andrew Muvesi from Uganda, Gaa Capital. Welcome, Andrew. Green finance is relatively new in countries like Uganda. Are you prepared to finance MFIs that will pioneer any innovative products in this space?
Exactly. No, precisely, Andrew, our fund mission is precisely this, that we support institutions that enter into green financing, so this is the mission, the theory of change that I explained during the presentation, and I mentioned Natalia in one of the previous questions, we are not here only to expand the actions of some institutions that are already doing green finance. We're here to support institutions that still haven't done it and want to do it and want to pioneer the sector. So, if you are in an MFI in Uganda that are looking for this, please contact us. And Uganda, we're currently now looking at pipeline in Africa. So, the timing is right for us to invest in an MFI in Uganda.
Yeah, I'm very happy you can connect, and that from this webinar there could be future business relationships. Right. And to finalize for a second time. Rian Hasulega wanted to comment it also that it's a challenge to have longer durations, isn't it? And I guess he will be interested to know, how do you address this challenge?
Yes. Yes.
To the hedging, referring to the hedging.
That's true. That's true. So hedging becomes expensive, and it's true, it's challenging. Especially in some currencies. Especially in sub-Saharan African currencies. So far, our hedging provider, we work with different platforms, including MFX Solutions and TCX. They have provided hedging enough, for our first cycle. Remember that we first offer 2 or 3 years that are renewed for another 2 or 3 years, depending on some specific metrics, including social metrics, social targets having been achieved, So for these 2 or 3 years, usually we haven't really found trouble in hedging against the euro, even including in some transactions in sub-Saharan Africa. But they become expensive. The trick is that sometimes we are not competitive after the hedging. The interest rate that we can offer to an MFI in Ghana in Thesis, it maybe is not competitive against what the local banks are offering. But that's something I think is very common among all impact investors out there, not only ourselves. And what we always tell MFIs is that they need to diversify their funding. Just in case at some point there's a problem in the country and local funding dries out. It's always good to have worked previously with international funders, even if they are a bit more expensive.
Yes. Good. Thank you very much, Agustin. I think it was a pleasure to have you here in our webinar series. I am very thankful also for all the participants to have you here, to be so active with your questions, to Agustin for your interest in Gaa Capital, and seeing also as an example also for other funders that want to promote green inclusive finance. It is a good opportunity to remind the audience about the Green Index 3.0 trainings, the next one on Friday, tomorrow, in French, and also about the European Microfinance Week that will take place next week from the 17th to the 19th, and with more than 50 sessions, many speakers, over 6 sessions on green inclusive finance, we will have our annual meeting from the Green, Inclusive and Climate Smart Finance Action Group, as well as the opening plenary, what has happened after the COP26, and many more sessions. So you are welcome to participate, to register, and also to participate in our future webinars. Thank you very much.
Okay. Thank you very much, Natalia, and all of you and all the audience. I'm looking forward to connect with some of you after the webinar.
Yeah, so here is Agustin's email. And for all that want to contact us from the Green, Inclusive and Climate Smart Action Group, here is also our contacts.
Thanks.
Goodbye.
Bye-bye. Thank you. Thank you. Have a nice rest of the day.